You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where investing is made simple. It's wonderful to have you. We're always grateful for each and every person that tunes in, so it's wonderful to be with you. And today's podcast, interesting topic. I'm joined by a great friend and a colleague and a team member and one of our greatest assets at the Cash Flow Academy. Corey Halliday is with us today. Corey, how are you, sir?
Hey, I'm doing great. I'm so excited to be here. This is fun. Well,
it's going to be a blast. And, most people that have taken our courses at the Cash Flow Academy know you are the smartest instructor.
I don't know about that.
When you're competing with me, it's pretty easy to be the smartest guy.
I'm about half as tall as Andy and about half as good. So,
well, I don't know about that. But Corey is one of our wonderful instructors and resources. He and I have taught a lot of classes together, and I thought it would be fun to do a podcast together. And we're actually going to do, I think it'll be a 3 or 4 part series. We'll probably get it done in 4 parts. We're going to do it on the 4 pillars of investing. We've brought in so many guests to get their point of view, and we'll continue to do so. However, when I look at where the market is right now and where it's going, I just don't think there's ever been a more important time to talk about the 4 pillars. And we'll talk a little bit about how it came to be and why this is an important topic, the 4 things a person can learn about investing to really increase their financial IQ and develop cash flow. But before we get into the first pillar or all 4, everyone I think knows who I am, but a lot of people don't know who you are, Corey. So why don't you give us a little bit of your background, where you come from, how you got into investing, maybe some of the thing of all the people we've ever had on the podcast. I would say there's no one I've ever had in all the time we've done this that is a better risk manager. So talk about being an option principal and the importance of risk management maybe, and just tell us who you are.
Yeah, for sure. So I got my start back in the early 2000s, and interestingly enough, this is about the time we met each other.
Yes.
I was introduced to Andy in the early 2000s, and Andy became a great mentor to me. And I learned from Andy the importance of really, I would say, the financial markets, but also just personal finance, just taking control and really doing better with your money. And what really struck me was, that potential that your account can grow if you give it time and you give it returns. And so I just became fascinated with the financial markets. I lived, I ate, slept, breathed anything that I could get my hands on financial markets, reading books and so on. And so I took that and really just wanted to work in the financial markets. And I started on the ground floor, got my Series 7 license, and kind of worked my way up the traditional route. I became an options principal, and that's what you were referencing. That's a Series 4 license. And it basically means that I oversaw the trading for the option firm. And we were a New York-based firm, and I oversaw the option trading at the firm, and did that for a number of years and absolutely loved it. And I love teaching. I love analyzing risk. I love finding opportunities. And, as long as I've done this, everything that I have ever done in the financial markets, it all traces back to the 4 pillars. The 4 pillars are really the bread and butter. They are your foundation. If you're going to become a professional basketball player, well, guess what? There's the foundation, the fundamentals of, you've got to be able to dribble, you've got to be able to pass, you've got to be able to shoot a little bit. And so there are different things that kind of are what you build upon. And that's what the 4 pillars are. So you can get into more advanced option strategies, and you can do a lot of things that I did as a Series 4 options principal, and anyone can do it. It doesn't matter where you were born. It doesn't matter your education level. People can get there to where they're trading advanced option strategies. but it's always going to come back to the 4 pillars. If you have the 4 pillars, you have a solid foundation. And so I'm really excited that that's our topic, and specifically the topic today, because I think it's so relevant to where the markets are and very important and timely towards where they're going in the future.
So, when you were with that New York firm, how many traders do you think you were in charge of helping manage the risk? I think it's critical that people to appreciate. If you want to appreciate risk, it's funny. We live in a world of sound bites where we say, there's superlatives. This guy's the best, and this is the most incredible, and every show you do is the most important one. In this case, it's so. I think it's critical that people really understand, and get a movie in their mind of what an option principle is. So how many different traders?
So we had thousands. The good news is that I wasn't personally in charge of, but technology helps you to manage risk, because you can run different scenarios. They call it value at risk, VAR, where you say, okay, if the S&P moves 2%, 3%, what does that do for each of these accounts? So we could kind of identify where problem areas were potentially ahead of time. And you can do the same thing. We'll talk about in different advanced option strategies courses about analyzing your delta and your gamma and your theta. And those things sound really super complex. I want to point out that if I can figure them out, now I've studied this stuff a lot, but I'm just telling you, we have teachers, we have firemen, we have stay-at-home moms. We have people that do this from all different walks of life. So you don't have to be a Series 4 options principal to be able to analyze the risk efficiently and effectively. And that's the beauty of technology. Every person can open up a brokerage account that will give you the gamma and the data and the theta and these numbers that we teach in the courses. So technology has come a long way. There's never been a better time to be an investor, because you have so many tools, and with competition brings prices down. The commissions we used to pay 20 years ago versus what you're paying today is night and day difference. In fact, there's even some brokerages that are completely free. So we analyze risk, but technology helps us to do it efficiently. So it's not, a full-time constant battle where you're stressing or anything like that. And that's the good news of it. Technology helps.
So, everyone has their own pillars in their life of whatever they are. It might be spiritual pillars, or it might be pillars for your marriage. And I suppose when it comes to investing, many people have their pillars. And I'll tell you how the 4 pillars came to be is when I first met Robert Kiyosaki. He has been a great mentor to me in 2 ways. The first one, obviously, as a teacher of, he wrote the greatest personal finance book of all time, right? He's a master on his topic of financial education. He helps people see that world through a very powerful lens and a great context. He's a master of context. And so when I met him years and years and years and years ago, and he began to invite me to travel a little bit with him, the first big trip we took was to Asia and Australia, and we went to Singapore and Malaysia. And that's when I began to be mentored by him as to be a teacher. In other words, he didn't just teach me how money worked, he began to teach me how to teach. And that's been one of the great blessings in my life. And so he asked me to write a book in the series, the Rich Dad Advisor series. And I wrote a book called Stock Market Cash Flow. And he says, you got to have a good subtitle. And it forced me to say, what have I learned from my mentors? What have I learned from the mistakes I've made, which was a great body of research. We had plenty of research there. And what have I learned in this time? And what it did is it forced me to ask myself, Corey, what do I know about this, or what do I think I know about it? And I began to categorize things, and I realized that everything I've ever done or learned or watched falls into one of 4 things. When you practice trading, there's really 4 things you do. And so the 4 pillars are these. There's something called fundamental analysis. There's something called technical analysis, cash flow, and risk management. And so we're going to do this series on the 4 pillars to give people an insight. And the first one is called fundamental analysis. That is, really looking at the strength of a business, a company, a real estate project, a household, a government. We'll get into that. How strong is an entity? How strong is it? And then technical analysis is the charts. And those first 2 pillars are about gathering information, right? I really can't change how a company reports. I can't change their chart, but I can look at it. And after I have that information of where they are fundamentally, where they are in the chart, now you and I have the opportunity to say, well, how might we glean some cash from this? And so the second 2 pillars are cash flow and risk management. That's where you can take action. You can, go long or short. You can sell an option. You can collect a dividend, whatever your strategy might be. So, we separate those first 2 are about information gathering. The second 2 are about the action that you take. And so with that, let's dive into our conversation a little bit about fundamental analysis. What would you say it is if you were to, say when I'm listening to CNBC and they say, well, the fundamentals look good or the fundamentals don't look good. What do they mean when they say the fundamentals don't look good?
They're really talking about the business itself, the financial statement, the details of earnings and growth, and they're suggesting that they like the way that the fundamentals match up. Income, expenses, assets, liabilities, what you have listed there. That's fundamentals of a corporation. You can also do fundamentals like you talked about on governments. And when you talk about fundamental analysis, a good analogy is kind of, if you were to go into a store, you could add up all of the inventory and say, well, what is this store worth? What is it worth based on the products? And so you're just doing some sort of analytical work that says, I think this asset should be valued this way. And as stock investors, we do that because we can compare companies that operate in a similar industry. If you were going to analyze an energy company, let's say, there are a lot of energy companies that are very similar. ConocoPhillips is very similar to Chevron, which is very similar to Exxon Mobil, and so on. Well, by doing fundamental analysis, we can basically say, what do we think those companies are worth, and try to find value, because one of those companies might be trading at a significant discount to the other for one reason or another. And we might look to find opportunities. And the most famous investor of all time, Warren Buffett, is a big fundamental analysis guy. He says, I want to buy what is $1 of value, but I want to pay 50 cents for it.
Yeah.
And because he's done his homework, he can find those types of opportunities. You can do this in real estate. It's the idea of trying to buy a distressed property that you think is worth more than that. Maybe you have to put a little money into it or whatever it is, but finding value, that's the basis of fundamental analysis.
You mentioned Warren Buffett, and his mentor was Benjamin Graham. And Benjamin Graham wrote a book. It's not a light reading. It's called The Intelligent Investor. And I think it's still today the best book on fundamental analysis. I really do. Maybe not in the details of what you look at, what metrics you look at, but the overall context of a fundamental analysis. So to help listeners understand why this is such an important part of one's financial education, let's think about this on different levels. Let's talk about your household for a minute. And let's say I was going to invest in you. Corey and I are saying, hey, should we loan you some money? Corey and I are a bank. And a loan is an investment for a bank, right? They put money out there and loan it, and they're hoping to get a return. And so as I look at your what we call financial statement, that's really the heart of all fundamental analysis. Is as you look at a financial statement where a company or a person or an entity says this is where we are, you can gain tremendous insight about the positives, the negatives, and the pros and the cons. And what's interesting is if I were to look at your financial statement with Corey, Corey mentioned there's assets and liabilities. Well, I could learn a lot about you simply by saying, what assets do you have and what liabilities do you owe? We have income and expenses. I can learn a lot about you by looking at where your money comes from and how you cover expenses. And one of the things that's very easy to understand is the first thing I would do, not to get too granular, but I would ask this question: how does this person pay their bills? In other words, those obligations of food, clothing, shelter, medicine, taxes, that stuff never ends. And so we ask the first question, how does this entity or this family or this business pay their bills? And there's really only 3 ways they can do it. They can either do it with new income from a job or sales, new money, paying these new bills. If they don't bring in enough new money, they can always use old money, like money that was stowed away under the mattress in savings, or maybe you put some in gold that you could go sell and resource. And then you have borrowed money. And you see all 3 of those cash flow patterns around you in the world, Corey, don't you? You see the guy in the rat race that solves his income problem with a job. You see a person who's retired trying to solve his expense problem with money he saved over his whole life. And then you have like a U.S. government who tries to solve their expense problem with borrowed money. It's really only 3 ways you can solve an expense problem: income money, old money that was saved and invested, or from borrowed money. And so this works on every level. It works on, and in my 4 pillars of investing class, we divide this into 3 levels. You mentioned the government level, the corporate level, and the personal level. So the personal level is the most important one because that's the one that will determine your life. But you and I were speaking earlier today. Corey and I trade together, actually, to give you an idea of how important he is in my life. Every Monday, you and I spend, what would we say, maybe an hour, half hour or so.
Hour. Yep.
Yeah. And we just go through a joint portfolio that we have that we trade together. And we look for opportunities and make adjustments. But we were speaking this morning about Japan, and we were doing a fundamental analysis on Japan. For example, let's look at their liability column, and just share with the listeners what you and I were speaking about in terms of their debt.
Yeah, their debt has tripled in less than a decade. And you think about that, they've tripled their debt in less than 10 years. It's just astounding. I mean, and that gets to your point of, you can borrow money. You can either, you can bring in new money, right? For them, that's generating capital from, taxing or different money that they bring in, or they can use borrowed money, which is what they're doing. They're tripling the amount of liabilities they have out there. And it's just astounding when you think of it in those terms. And if we think about it from an individual that we were investing in, would we rather invest our money in a person that can generate a lot of new money, or they have to tap into old money, or they have to go out and borrow money to be able to pay their bills?
Right.
We would feel more comfortable. We would feel more fundamentally sound investing in the first person that's bringing in new money that can cover all of the expenses. And what you've just learned is actually a fundamental principle. It's called debt to equity in the financial markets. That one of the first signs of trouble in a corporation is their debt starts to increase. Now, sometimes companies will take on debt, but they have a great business. They're just using it because it's cheap financing. That's not a business that's in trouble. But when companies, and you'll see it, their debt to equity starts to explode, it's not difficult to find where there's trouble. Go find the companies that are taking on a lot of debt. They're tapping into old money, the borrowed money, I should say, because basically the old money and the new money has run out. And as soon as you start borrowing too much and then you can't pay your expenses, what's the 4th step? If nobody will lend to you, it's bankruptcy.
Yeah,
so
it's
you either
default.
Yep. It's new money, old money, borrowed money. And then when nobody will lend you any money, the next phase is bankruptcy. And that's kind of interesting because, not to speak our book, but we actually have a position in something that maybe we won't touch on the name, but we think it's headed towards bankruptcy.
I'll we've been writing that.
Okay, go ahead.
Well, and I got to be careful. This is not a recommendation because you don't know if it's already got, lost. You don't know how much further it's going to go. But we have some short shares of GameStop, in our joint account. And I actually have some put options as well because of obsolescence risk, because, you know, they have a lot of cash. So they're not in the borrowed money phase yet. They're in the, but they're really, if you look at their fundamental analysis, what you're going to find is their sales are dropping, right? It's called obsolescence risk with the downloadable games and with, you know, it's a lot like the Blockbuster giving way to Netflix. GameStop is going to give away to the Apple Cloud and the Google Cloud and all the cloud games. And so when you look at a fundamental analysis of a company like GameStop, they've got to figure out sales. And so, you know, with a decline in sales, how are they paying their expenses now? Well, they're not doing it with new sales. They're doing it with cash that they've stowed away. Now, again, they're not into the part where they're borrowing money necessarily at great rates, but it makes us want to take a short position. Now, we have to have exit strategy, and, you know, their new CEO thinks that I laugh at this because you know, maybe I'm wrong. Maybe this guy's smarter than I am, and he probably is. But I had my basketball players at a basketball tournament, and I said, "Hey, you guys want to go hang out at GameStop and play games?" And they're like, "What?" I go, "Well, don't you think that'd be fun? You know, maybe go have a little soda fountain, and you could get a little lounge area, and you could have tournaments and play games at GameStop." And they were like, "Coach, that's really lame, dude. We play games in our bedroom," you know, because they networked everyone. How are you going to get everyone together at GameStop, right? But that's what GameStop's going to try to do. They're going to try and turn it into more of a place to hang out. And it's funny because their CEO, he goes, "Hey, if EA Sports or whatever, if EA is the Vatican, how come we're not the Catholic Church or whatever like that?" And I'm like, well, that's not the best analogy right now because they're not doing well either. But the fact of the matter is we take a position, cash flow position, a short position, partially because of doing a fundamental analysis. And here's what financial education is. It's when information has meaning. Does that make sense? Yep. When information has meaning. So you can really see stuff happening, and information is just information, and if it has no meaning, it's of no benefit. So what financial education does is, you mention a metric like debt to GDP ratio. Well, if a person has no education, that's meaningless. But if I look at a GDP, which is, you know, a country's ability to generate, you know, product, right? That's where taxes come from, right? I mean, if someone makes a transaction, let's say that someone pays an employee, well, that's a transaction that's taxable. And so that's part of the product. You know, that employer produced something, got paid for it, that's part of the product. Or maybe a company sells a product and they get taxed on it, right? Every time there's a transaction. And so if there's a lot of transactions, a lot of stuff being produced, that creates taxable events. And so if you have a huge debt but a small GDP like Japan, relative, you could be in trouble. You know, we in the U.S., we have about 22 trillion on balance sheet debt. Japan has about 12. Our GDP is 21 trillion. Theirs is like, I don't know, like 4. And so they have 12 trillion in debt, maybe 3 or 4 trillion in their economy. You know, they can't tax their people at a rate to pay their debt. So Japan's in trouble. And so that's an example of a fundamental analysis of saying, gee, you know, you made a great point earlier about they've tripled or tripled their debt. Right now, rates are pretty low. And so if rates were to get higher, and they're addicted to borrowing and they're having to sustain themselves with borrowed money, the cost of borrowed money could go up. It could go up significantly.
Yeah. And the reason there hasn't been as much a crisis right now is, what's interesting is, even as their debt has tripled, the amount they're paying is lower because rates have gone down so much. But of course, if rates go back up, then the amount that they have to pay in interest skyrockets because they have tripled the debt at higher rates. So that becomes a real issue if rates go back up for them. And it's just kind of an interesting world we live in, where capital is so cheap, interest rates are so low, But what happens when rates go back up? You're going to find, as the Warren Buffett analogy says, you have kind of the ocean, and the tide comes in and the tide goes out. Well, when that changes, you're going to find out who's swimming naked, who's in trouble. And so that's the issue fundamentally, is right now, I think a lot of corporations and a lot of governments are getting away with it because interest is so cheap. It won't be like that forever. You have to understand that these things are cyclical, and at some point rates will go back up, and you're going to find out who's in financial trouble. And that brings about, a crisis here and a crisis there, and some companies that will go bankrupt. And companies like GameStop that we talked about, the way they've been able to survive is through store closures, they sold off some assets. They had like Spring Mobile, and they sold that off to raise some capital. So they've been able to do some things to stem off the crisis. But if the underlying business is
the
not
fundamental problem,
the fundamental problem is the underlying business is problematic. And then when you're losing money, you're hemorrhaging cash. Well, you can only sell off assets for so long until you don't have any assets left, and then you're in real trouble. And that's kind of that spiral that they've been in. So
you bring up a great point. The difference, we talked about the problem of expenses and how you go about that. Income ideally is renewable, right? Like, let's look at someone in the rat race. You get paid, you get a paycheck, you spend it on your phone bill. You get paid, get a paycheck, spend it on your phone bill or your, medical bills or your food bill, whatever. Get paid. And it just kind of goes like that. Great, because you have this idea that there's perpetual income as long as you show up to work and don't lose your job. But the moment you start trying to solve that expense problem with your asset column, now you have an hourglass, right? Now you have a fixed amount of stuff to where, and that's where GameStop is okay, let's sell this off. We have this cash, let's sell this off. And it's really now a race against time for a company like GameStop to say, hey, we either get the new money figured out and get the revenues back up, or we're going to wind up going to borrowed money and then bankruptcy. I mean, that's really where they're at. They're in a dire situation. They've got to figure out how, and the best way to address expenses is with assets that produce income, like Warren Buffett has. Warren Buffett has asset-rich companies. He's got Coca-Cola. Well, they're still selling Coke, right? The drink, not the powder, right? He's got Delta Airlines. They're still flying the friendly skies. Fruit of the Loom, they're still selling underwear. See's Candy, still selling chocolates. As long as the sales are rolling and it's managed fairly well, you can say, okay, this is going to be a company I wouldn't mind owning. I can see profits in the foreseeable future. There's value here. But when you have a company or a business or a government or a person that starts struggling to pay their bills, you can really gain a lot of insights from looking at their financial statement and their growth and stuff like that. So that's why the first pillar is what it is, even real estate investors, there are certain numbers that are associated with fundamentals. For example, in the stock market, if you look at a business as just a machine that produces money, right? Let's not call it a company. Let's say it's like a jack in the box where you turn the crank and money comes out. Well, the question is how much money does that jack in the box produce? And what's the price of the jack in the box? And with that, we get a metric called price earnings. In other words, how much are we paying for the jack in the box to produce this amount of money? If you really reduce down a business or real estate project to that, well, the same is true with real estate, except they call it net operating income, or they call it cap rate. They'll say, look, what's the net operating income and how much am I paying for this? And so how much rent does this apartment building and vending and parking, how much does that produce? And what am I paying for the building? Again, you're just paying for a machine or a jack in the box that makes money. And how do you know what a good price is? Well, look at, like you said, compare apples to apples. Say, all right, well, I have this apartment building, that apartment building, the other apartment building. They all produce this amount of money. Well, they should be comparably priced if they're, have comparable profits. And that's how Warren Buffett hunts down value. He says, look, this is a machine that makes money. The machine looks healthy on its balance sheet. What should I pay for this. And he tries to find, assets that their price are unjustifiably low based on the amount of cash and potential cash they can produce. Anything you want to say on that?
Yeah, I mean, I think you hit the key points. He looks for value in anything that he's buying, and it can be a very strong business where he's buying it at a discount, or sometimes he'll step in times of distress. I'm reminded of his Bank of America investment. I stepped in for Goldman Sachs and so on. During the financial crisis, these companies needed some capital, and by Berkshire Hathaway providing that capital, he got very, very good terms, which was then he had these warrants which he could convert. It was convertible into stock. So he basically created this dynamic where not only was he collecting a nice interest payment for this capital he was giving them, but he could convert that into equity, into an ownership stake in the business. And so, as a fundamental investor, it's kind of that same approach. You can buy a great business that's growing rapidly and try to get that at a great value. Or sometimes there's a distressed opportunity. We wouldn't be against investing in GameStop on the upside if they really turned it around and if there was a change in the business. But we don't see any reason fundamentally to do that. So, you don't care what the company is. You care about the value that it's offering. And that's kind of the fundamental approach is I'm not picking favorites. I'm just letting the opportunities come to me. And sometimes there's opportunities to play the asset to go up in value. And sometimes there's opportunities to play for the asset to go down in value. And the financial markets give you that opportunity to make money as an asset's going down, which is very cool. That's very different from most other areas where you really can't profit and take advantage from downward movement, but with stocks we can do that.
See, and guys that come late to the table, it's tough because there's not a lot of money left in GameStop. It's sitting at $4 now, so you come late to the table, not much fat there left. The reason that I was talking to my producers about doing a series on the 4 pillars, and they thought it was a really cool idea based on the feedback we get from our listeners. The reason is I'm always harping every podcast on financial education. Well, what is financial education? What is it? And, this is a big part of it. They say they don't teach it in school. And so if they were to teach financial education in school, what would that look like? For example, I know what academic reading, writing, arithmetic, science, history, geography, maybe a foreign language. I know exactly what that looks like. Well, a lot of people don't even know what financial education courses would look like. Well, I'll tell you what they look like. Fundamental analysis, technical analysis, cash flow, risk management. And accounting, it's not the same as accounting, because what accounting does is they teach you how to come up with the numbers. But accountants don't interpret the numbers. They just account for everything. That's really important. Warren Buffett is not an accountant. He's an investor. Now, he has accountants, but the accountant's job is to simply report, this is what our sales were, this is what our debt is, this is what our expenses are, this is our free cash flow. There's 3 statements they produce: balance sheet, assets and liabilities, profit and loss statement, income and expenses, and then what we call a statement of cash flow, where we look at all 3 of those cash flows. How much money went in and out of operations through the expense column, how much money went in and out in terms of assets we bought or sold, capital expenditures, and how much money went in and out depending on the amount we borrowed and paid back. And so those 3 statements, income statement, balance sheet, and statement of cash flow, that's the heart of financial education. It's the heart of a fundamental analysis. And if you're a real estate investor, you're going to use a fundamental analysis to decide whether or not there's value to be had. And you're going to learn numbers like cap rate and net operating income and debt. If you're looking to buy stock, you'll learn numbers like PE ratio and enterprise value and EBITDA. NOI in real estate, net operating income, EBITDA, earning before taxes, interest, depreciation, or debt and amortization and depreciation. All these numbers have meaning, and the accountants don't necessarily interpret what they mean. They just produce the number. Right, Corey?
That's right. They're looking at giving the numbers, and then there's an interpretation of that, and that's where we do that apples to apples comparison.
Yeah.
It's very important that as you look at a business entity and you think about putting your capital in there, you want to take, sometimes technical analysis is looking at the charts, and chartists say, well, I don't care about the fundamentals. And then fundamental investors will say, well, I don't care about the chart. They're intertwined.
Yes, they are.
Why are people going to be buying a certain asset? Well, typically it's because the business is performing. And so there's a reason that Amazon and Apple and these stocks that generate tons of cash have gone up in value for a long period of time. That's momentum in the chart because it's an improving business. At a certain point, though, even great businesses will get overvalued. Well, the chart isn't going to necessarily tell you where it's overvalued, right? And so fundamentals can help to give you that insight. When a chart is going down, well, sometimes there's value there, but we can marry the two. And so, I think that as we look at that first pillar today, at fundamental analysis, just start with some basic metrics. Start with a price to earnings ratio. Go read up on it. Certainly in our 4 pillars, we teach what a price to earnings multiple is and how to interpret that data. Very, very good stuff that will get you on the right frame of mind for being a better investor in the financial markets.
You mentioned the importance of having both fundamentals and technicals, and we'll talk more about technicals in our next, our next installment, I guess, in this little 4-part series. But it is important because a specialist or a market maker, they never look at the fundamentals. In other words, the person that actually prices the stock has no concern for that. He's just looking at buyers and sellers, supply and demand. So because of that, it makes us, as investors, it behooves us, I think, to look at both. So in a nutshell, a fundamental analysis is when you look at an entity, a business, a government, a nonprofit, a church, or a household, and you say, look, let's see what kind of financial shape they're in. What kind of income does this entity generate? What type of expenses is it laden with? What are its assets and liabilities? And by analyzing that in an intelligent way, then you can take those numbers from the accountant and they have meaning, and you just make better financial decisions. And at least now you have an informed decision rather than the approach of diversification where you say, look, I'm not going to worry about the fundamentals. I'm just going to buy everything. I'm just going to buy. That's really what a Vanguard 500 mutual fund does, is it abandons totally fundamentals. It abandons this idea, 100% abandons it and says, look, we're going to buy the S&P 500, good, bad, and ugly. We're just going to hope that it grows over time. That is not what a Warren Buffett would do. Warren Buffett read the book, The Intelligent Investor. And the word intel is like a CIA term. Let's go gather intel. Let's go get intelligent. Let's go gather intel. And so the intelligent investor is someone who actually will gather information. You would never buy real estate the way, the Vanguard 500 buys stocks. You would never do that. You'd never say, well, let's just buy all the real estate and hope the winners outnumber losers. There are values out there where the price is unjustifiably low based on the performance of the company. There always is. And it's a willingness to do the work of fundamental analysis to evaluate an investment before we get in, not just buy everything. That's why I have a lot of heartburn with 401ks, is I'm not convinced that there's a lot of fundamental analysis going on there for sure. So any last words on this pillar and why it's important?
Yeah, two final thoughts. First one, GameStop is not necessarily a stock to go out and be shorted. We shorted it a lot higher. It's gone down a lot. There's maybe not a lot of meat on the bone, and that was not financial advice, first of all. And secondly, you reminded me of one of the great quotes of all times, which was by Benjamin Franklin. He said, an investment in knowledge pays the best interest. And I thought that was just a great way of putting it, that when we talk about fundamental analysis, and even you just being here and listening to the podcast is an investment in more knowledge. And putting that to work with fundamental analysis. You don't have to be an expert in every fundamental metric. You can actually keep it rather simple, but still do some very solid fundamental work. And that's the way we like to do it. We're going to look at some of our key metrics that will tell us whether a business is improving or going down, right? We can look at their growth rates. We can look at some things that just tell us very simply and easily, are their earnings going up or are they going down? And as we start to gather that information, it's going to help us to make a better informed decision with our money and our investments. So a lot of fun.
Corey, we love everything you teach. We're so grateful for all you do for the Cash Flow Academy in general. And we never had you on the podcast, so we were long overdue. Thank you so much for the time. I'm excited to be with you again. And we'll do the second installment on technicals as we do just a little bit of information on the 4 pillars of investing, what they are. And, these are the classes that a person wished they could have had in high school, I suppose. If there were topics on financial education that were taught, quite possibly these would be the titles. So
this would be it.
Yeah,
Agreed.
great stuff.
I had a blast.
We'll see you next time. You've been listening to the Cash Flow Academy podcast, where investing is made simple. I'm your host, Andy Tanner. We've had our conversation with Corey Halliday. We'll see you next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.